9 days ago, SpaceX had the biggest IPO in stock market history. $75 billion raised. A bell rang on the NASDAQ. Billboards lit up Times Square. 2 days later, the stock hit $225, up 67% from the offering price. People who got even a single share were posting screenshots online. And then it lost $620 billion. In 2 days. The average person who bought shares after the IPO, not at the offering price, but on the open market, is right now almost exactly breaking even. After buying into what felt like the opportunity of a lifetime. And the official reason for the crash, the thing every news outlet is reporting, is not actually the real lesson here. Today, we are going to show you what actually happened, why it happened so fast, and the one principle this entire story teaches that applies to every hyped investment you will ever consider buying for the rest of your life. Here is what makes this story worth understanding deeply, even if you never owned a single share of SpaceX. This is not really a story about rockets or satellites or Elon Musk. This is a story about what happens to ordinary people's money every single time a hyped investment meets reality. SpaceX priced its IPO at $135 a share. It opened trading and closed its first session near $161. By the second trading day, shares hit an intraday high above $225. Retail investors poured $370 million into the stock in just 3 trading sessions, more than 4 times what flowed into Nvidia over the same period. Nearly 1 million call options traded on day 1 alone, traders betting aggressively on even more upside. This was not measured investing. This was euphoria. And then, 6 days after the IPO, the company made an announcement that changed everything. On June 16th, SpaceX announced it was acquiring AnySphere, the company behind the AI coding tool Cursor, for $60 billion. Entirely in stock. Cursor was a real, valuable business, generating roughly $2.6 billion in annual revenue. SpaceX was not buying nothing. But here is the mechanism that should concern any investor. Because SpaceX paid in stock rather than cash, issuing new shares to complete the deal, every existing shareholder's ownership stake got diluted by roughly 3.4%. Famed investor Bill Ackman explained the logic plainly on social media. One of the reasons SpaceX is so valuable is its high valuation itself. Because the valuation is so high, a relatively small percentage of dilution can complete a $60 billion acquisition. In other words, the stock was so expensive that the company could essentially print money to buy other companies. Remember that $225 peak from the beginning of this video? That peak happened the same day the Cursor deal was announced. Initially, investors loved it. The stock jumped on the news. But within 24 hours, the mood shifted completely. Morningstar, one of the most respected independent research firms in the industry, had already called SpaceX's IPO price significantly overvalued before the company even went public. After the Cursor deal, they cut their fair value estimate even further, from $63 a share down to $62. $62, against a stock that was trading above $200. A gap of more than 200% between what the most respected analyst firm thought the stock was worth and what people were actually paying for it. Here is what almost nobody is saying clearly enough about this entire sequence. The crash was not really caused by the Cursor deal itself. The crash was caused by the fact that the stock had risen so far, so fast, on pure excitement, that any piece of news requiring genuine analysis was enough to break the spell. Look at the timeline. A hawkish shift in Federal Reserve language about interest rates staying higher for longer hit the same week. That alone triggered a 5.6% single-day drop. Combine that macro pressure with a dilutive acquisition and an already sky-high valuation, and you get a stock that gave back 20% of its value in roughly 48 hours. This is not unique to SpaceX. This is the pattern of almost every hyped IPO in market history. Rapid rise, driven by retail enthusiasm and scarcity of available shares. Then a pullback, driven by the first piece of news that requires investors to actually do math instead of just feeling excited. And there is more pressure still ahead. SpaceX faces a lockup expiration window opening as early as late July, when insiders who bought shares at a fraction of today's price become eligible to sell. The company's first quarterly earnings report as a public company is not due until September 2nd. Until then, the stock price is being set almost entirely by narrative and sentiment, not verified financial results. One investor put it bluntly when he exited his position just days after buying in. It's struggling too much and can't find its footing. Meanwhile, another investor who received only a fraction of his requested shares chose to do the opposite and bought more. Both of those investors had access to the exact same information. They made completely opposite decisions because hype-driven investing is not about facts. It is about psychology. You may never own a single share of SpaceX. That is fine. This story is not really about that company. It is about 3 principles that apply every single time a hyped investment shows up in your life. And there will be many more of these in the years ahead. Principle 1. If a stock's price depends on a story instead of a number, be extremely cautious. SpaceX's price action over its first 9 days had almost nothing to do with quarterly earnings because there were none yet. It had everything to do with narrative, Elon Musk's reputation, AI ambitions, space dominance. Stories move prices fast in both directions. Verified numbers move them more slowly and more reliably. Principle 2. The first few days of any hyped investment are usually the worst time to buy, not the best. Vanda research data showed retail buying interest in SPCX collapsing from $370 million in 3 days down to just $9 million by the following Thursday. The crowd that rushes in first is almost always buying at the most emotional, least rational price point available. Principle 3, and this is the one that matters most for your long-term wealth. Respected, independent analysis is worth more than excitement, even when it is unpopular to listen to it. Morningstar called SpaceX significantly overvalued before the IPO even happened, when literally everyone else was celebrating. They were not popular for saying it. They were also closer to being right than the crowd that bought at $225. You do not have to agree with every bearish analyst, but dismissing sober analysis entirely because it conflicts with excitement is exactly how retail investors end up exactly where the average SpaceX buyer is right now. Breaking even, at best, on what was supposed to be the opportunity of a lifetime. SpaceX may still turn out to be an extraordinary long-term investment, Starlink is real. The rocket business is real. Nobody knows the ending of this story yet. But the first 9 days already taught a complete lesson, regardless of how the rest of the story plays out. Hype moves fast. Math moves slower. And the gap between the two is exactly where ordinary investors lose money.
Here is what just happened in plain numbers. SpaceX IPO'd at $135, peaked at $225 within 2 days, then crashed 20%, erasing $620 billion in value, after a $60 billion dilutive acquisition collided with a hawkish Fed and an already overvalued price. The average post-IPO retail buyer is roughly breaking even right now on what was sold as the opportunity of a lifetime. 3 principles to carry forward. If the price depends on story instead of numbers, be cautious. The first few days of hype are usually the worst entry point, not the best. And respected independent analysis deserves your attention, even when it is unpopular. This will not be the last hyped IPO you ever see. But it might be the last time you fall for one the same way. If this video gave you a clearer way to think about hype-driven investing, hit that subscribe button. Every week on First Million Club, we break down exactly these kinds of real money stories with real numbers, so you stay one step ahead of the next hype cycle instead of caught inside it.